If you observe carefully what the Federal Reserve says versus what it actually does, you'll notice something deeply disturbing. The language they use in their statements, the metrics they highlight in press conferences, the reassurances they provide to markets, none of it matches the aggressive actions they're taking behind closed doors. While Jerome Powell tells you inflation is under control and the banking system is stable, the Fed is preparing for something far more serious. While they promise soft landings and measured responses, their actual behavior reveals deep concern about forces they can no longer control. This matters because the gap between their words and their actions represents the single biggest threat to your retirement savings right now. What I'm about to share isn't speculation or fear-mongering. It's pattern recognition based on observing central banks for over 4 decades, understanding what they do when they're truly worried versus when they're managing public perception. This isn't a prediction. It's a logical consequence of understanding how central banks operate when they face impossible choices. I've spent more than 40 years studying monetary systems, credit cycles, and central bank behavior across multiple countries and economic eras. I've watched the Federal Reserve navigate 8 different crises, and I can tell you with certainty, the current situation is fundamentally different from anything we've seen in recent decades. When you understand incentives, you understand behavior. The Federal Reserve's primary incentive isn't your financial security. It's maintaining confidence in the monetary system itself. That incentive creates a predictable pattern. They tell you what keeps you calm while doing what they believe keeps the system functioning. Right now, the divergence between these two objectives has never been wider. Consider 3 specific data points that reveal this gap with stark clarity. First, the Fed's balance sheet expanded by $4.8 trillion during the pandemic, but has only contracted by $1.1 trillion since they began quantitative tightening, leaving $3.7 trillion of permanent monetary expansion embedded in the system. Second, while they raised rates to 5.5%, the highest level in 22 years, they simultaneously expanded emergency lending facilities that pumped $300 billion into regional banks during the March 2023 crisis. Third, their own projections show they expect to cut rates by 150 basis points over the next 18 months, despite inflation still running well above their stated 2% target. These aren't random policy choices. They're the behavior of a central bank that knows something the public doesn't, that sees risks they're not yet ready to communicate. To understand what the Fed is actually telling you, you need to understand the fundamental mechanism they're trapped in. Think of the Federal Reserve as managing a massive dam with water rising on both sides. On one side is inflation, the rising water level that threatens to overflow and destroy purchasing power for everyone holding dollars. On the other side is debt, $34 trillion in government obligations, $12 trillion in corporate debt, $17 trillion in household debt, all of which becomes mathematically impossible to service if interest rates rise too high. The dam keeper's job is to release just enough water to prevent overflow without causing the dam structure itself to collapse from the pressure. But here's the fundamental problem they face. The water level is rising faster than it has in 40 years, while the structural integrity of the dam itself has never been weaker. Every time they raise rates to fight inflation, they stress the dam's foundation. Every time they lower rates or expand the money supply to protect the dam structure, they add more water that will eventually need to be released. This is the impossible choice they face, and their current communication strategy is designed to hide this dilemma from public view. Right now, 3 specific pressures are making this balancing act increasingly unstable and potentially unsustainable. The federal government is running deficits of $1.7 trillion annually, requiring constant new debt issuance that must be financed at these higher interest rates, creating a vicious cycle where higher rates increase the deficit, which requires more borrowing, which puts upward pressure on rates. Commercial real estate values have declined by 28% since rate hikes began, threatening $2.9 trillion in outstanding loans held primarily by regional and community banks. Regional banks are sitting on $650 billion in unrealized losses from bonds and securities they purchased when rates were near zero, creating hidden fragility in the banking system that could trigger runs if confidence wavers. Each of these pressures forces the Fed to choose: protect purchasing power through higher rates, or protect the financial system through lower rates and expanded liquidity. Their words say they're choosing the former. Their actions reveal they're desperately trying to save the latter. History is an excellent teacher when it comes to understanding central bank communication during crisis periods. What we're witnessing now is a pattern that repeats whenever monetary authorities face conflicts between stated objectives and systemic stability. In August 1971, President Nixon closed the gold window. For months prior, Treasury officials assured international partners that the dollar's gold backing was solid. Yet behind the scenes, gold was flowing out of Fort Knox at an unsustainable rate. When Nixon announced the closure on August 15, he called it temporary. That temporary measure became permanent. The lesson: reassurance before radical action. The 1970s inflation provides another example. Fed Chairman Arthur Burns repeatedly characterized inflation as temporary: food prices, oil embargoes, supply disruptions. Meanwhile, money supply was expanding at double-digit rates, with M2 growth reaching 13% in 1972. Burns faced enormous political pressure to keep rates low. The Fed's words said inflation was transitory. Their actions, continued money printing and negative real interest rates, said otherwise. By 1980, inflation peaked at 14.8%. It took Paul Volcker raising rates to 20% and inducing recession to break the cycle. The 2008 financial crisis offers the most recent example. In March 2008, Fed Chairman Bernanke testified that the subprime crisis was contained with minimal systemic risk. Yet internally, the Fed organized emergency weekend meetings to facilitate Bear Stearns' sale, providing $29 billion in financing. Over 6 months, officials emphasized the banking system was sound while arranging bailouts and expanding lending facilities. When Lehman collapsed in September, it wasn't a surprise to the Fed. It was the outcome they'd been trying to prevent while maintaining public confidence. The gap between public reassurance and private panic was enormous, and those who believed the reassurances lost fortunes as markets declined 57%. To understand what the Fed is actually telling you right now, you need to understand 3 fundamental principles that govern central bank behavior during periods of systemic stress. The first principle: central banks always choose the financial system over the currency. This isn't cynicism, it's institutional reality based on how central banks function. A central bank's primary function is to maintain the operational stability of the banking and credit system. Currency value, while important, is secondary to system stability. Think of it like a hospital emergency room. If a patient comes in with both a broken arm and a stopped heart, doctors work on the heart first. They're not ignoring the broken arm, but they're triaging based on what kills the patient fastest. For the Fed, a financial system collapse is the stopped heart. It kills the patient immediately. Currency debasement is the broken arm. It's painful, it has long-term consequences, but it doesn't cause immediate system death. This is why during the March 2023 regional bank crisis, the Fed created the Bank Term Funding Program literally over a weekend, providing unlimited liquidity to prevent bank runs. They didn't debate it. They didn't gradually phase it in. They acted instantly because system stability was threatened. Meanwhile, inflation was running at 6%, well above their stated target. Yet they expanded the money supply by hundreds of billions because the alternative, allowing banks to fail, would have caused immediate systemic collapse. Understanding this principle explains why their current communications emphasize inflation fighting, while their actual facilities and programs emphasize financial system support. The second principle is that central banks operate on fundamentally different time frames than they communicate publicly. When the Fed tells you they're targeting 2% inflation, they're describing a long-term equilibrium state, not a near-term objective they expect to hit. When they show you their dot plot projections for rate cuts, they're displaying a desired path, not a committed timeline they're bound to follow. But they can't communicate this nuance publicly because it would undermine the forward guidance mechanism they depend on to influence market behavior and expectations. Think of it like a restaurant menu. The pictures show beautiful, perfectly plated dishes arranged with artistic precision. That's the ideal outcome, the aspiration. What actually comes to your table might not match the picture exactly, but the restaurant can't print menus that say, "Results may vary significantly from images shown," because it would undermine confidence. The Fed's projections are the menu pictures. Their actual policy implementation is what arrives at your table. Right now, the gap between these two is significant and growing. The Fed projects gradual rate normalization and inflation returning smoothly to their 2% target. Their actual behavior, maintaining elevated reserve balances, expanding lending facilities during stress, and preparing infrastructure for rate cuts despite persistent inflation, reveals they expect continued intervention, requiring activist intervention. They're preparing for a crisis management scenario while publicly communicating a normalization scenario. The third principle is that Fed communication is designed to manage market expectations and maintain confidence, not to provide full transparency about the risks they perceive. This sounds harsh, but it's functionally necessary for how modern central banking works in practice. If the Fed told you exactly what they feared, that government debt levels are mathematically unsustainable at current interest rates, that the commercial real estate sector faces systemic losses that could cascade through regional banks, that financial institutions remain fundamentally fragile despite surface stability, that they may need to choose between fighting inflation and preventing financial collapse, it would trigger the very panic and instability they're trying to prevent. It's the monetary policy version of quantum mechanics. The act of observation changes the outcome. Think of a tightrope walker crossing between two buildings. If they look down and start thinking about falling, about the distance to the ground, about what happens if they lose balance, they're more likely to fall. They maintain balance by focusing on the rope immediately in front of them and trusting their training and instincts. The Fed maintains market stability by controlling the narrative, managing expectations, and trusting their policy toolkit. When Powell says the banking system is sound and resilient, he's not necessarily lying about current conditions. He's managing expectations to prevent the confidence crisis that would make the statement false. This is why you must observe their actions rather than listen exclusively to their words. The Fed's actions right now reveal far more concern about financial fragility than they're communicating publicly. Let me tell you a story. In early 2007, two families, the Hendersons and the Martinezes, both had $800,000 in retirement savings. Both were late 50s, planning to retire within a decade. The Hendersons listened to Bernanke's testimony that the subprime crisis was contained. They kept their conventional 60-40 allocation, heavily weighted toward financials and real estate. They believed the experts. The Martinezes heard the same reassurances but observed something different. They noticed the Fed cut rates by 50 basis points in September 2007, the largest cut in years, while claiming everything was fine. They saw emergency lending facilities being created, Bear Stearns requiring a bailout. They recognized the gap between words and actions. They reduced stocks from 60% to 35%, moved money into treasury bonds and gold, eliminated financial sector exposure, increased cash to 15%. When Lehman collapsed and markets crashed 57% through March 2009, the outcomes diverged dramatically. The Henderson family watched their $800,000 decline to $360,000, a loss of $440,000. They were 58 with limited recovery time before planned retirement. They worked 5 more years, reduced retirement spending by 40%. Their dream of traveling became budgeting and continued work. This isn't made up. It's the typical pattern for those who maintained conventional allocations through 2008. The Martinez family experienced something different. Their reduced stock allocation meant only 35% was exposed to the crash. That portion declined 57%. Costing $160,000. But their treasury bonds increased by $75,000 as investors fled to safety. Their gold rose from $80,000 to $140,000. Their portfolio stood at $660,000 in March 2009, a decline of $140,000 instead of $440,000. They bought assets at depressed prices in spring 2009. By 2012, their portfolio exceeded $1 million. They retired as planned at 62. By 2017, the Henderson family had $720,000, recovered but still below their 2007 peak. They'd worked extra years and sacrificed early retirement. The Martinez family had $1.35 million, had retired at 62 and enjoyed 15 years of planned retirement. The difference wasn't intelligence or luck. It was recognizing that central bank actions reveal truth while words manage perception. Now let's translate this to what really matters, how this affects you and your family's financial future. If you're between 45 and 70 with retirement savings between $300,000 and $2 million, the gap between the Fed's words and actions represents the most significant threat to your financial security in the coming years. The Fed tells you they're committed to 2% inflation and that rate cuts will only come when inflation is defeated. But their actions, preparing rate cuts, maintaining emergency facilities, allowing inflation to run above target, reveal they're more worried about financial system stress than inflation. Here's a plausible scenario based on observable Fed behavior patterns. Over the next 18 to 36 months, the Fed cuts rates by 150 to 200 basis points, despite inflation remaining between 3% and 4%. They do this because financial stress forces their hand. Commercial real estate losses mount. Regional banks face deposit flight. Government debt service becomes unsustainable at 5.5% rates. As they cut rates and potentially restart asset purchases, inflation accelerates. If you're 60 with $800,000 in a conventional 60-40 portfolio, your stock allocation faces pressure from slowing growth and multiple compression. Your bond allocation gets crushed by rising inflation and negative real yields. A conventional portfolio could decline by 25% to 35% in real terms, $200,000 to $280,000 in wealth destruction. The impact compounds. If you plan to withdraw 4% annually, $32,000 to supplement Social Security, and your portfolio declines to $560,000 in real terms, while inflation runs at 4 to 5%, your purchasing power gets hit from both sides. Your retirement budget needs to adjust by 40% to maintain the same lifestyle, or you withdraw more aggressively, accelerating depletion. If you planned $6,000 monthly in retirement, with inflation at 4.5% for 5 years, that lifestyle costs $7,466. But your portfolio declined 30% in real terms. You're now depleting at an unsustainable rate while living on less than planned. Based on these principles, here are practical guidelines for protecting your wealth. These are structural adjustments based on institutional behavior patterns. For someone between 45 and 70 with $500,000 to $2 million in savings, 30% in Treasury securities focusing on shorter durations, 25% in equity positions tilted toward energy infrastructure, commodities producers, companies with pricing power, 20% in precious metals with 15% physical gold and 5% silver, 15% in real assets including Treasury inflation-protected securities, 10% in cash for liquidity. What to avoid? Long-duration bonds, highly leveraged companies dependent on low rates, financial sector concentration, particularly regional banks, chasing yield in corporate bonds that become value traps when inflation erodes returns. Implementation. Don't make these changes in one move. Implement gradually over 6 to 12 months. This allocation may feel wrong for periods. Gold might stagnate. Friends might outperform short term. This is insurance cost. Don't confuse defensive positioning with pessimism. Don't abandon during rallies, and consult professionals for advice tailored to your circumstances. Nothing in this constitutes specific financial advice. Each person has different circumstances, time horizons, and goals. Consult qualified financial professionals before making any allocation decisions. The choice is yours. But remember what we've observed. The Fed's words emphasize inflation fighting and gradual normalization. Their actions, emergency facilities, preparation for rate cuts despite elevated inflation, balance sheet expansion during stress, indicate preparation for financial fragility that may force them to choose stability over currency value. This pattern has played out repeatedly throughout monetary history. Central banks always choose the system over the currency when forced to decide. The question isn't whether they'll make that choice, it's whether you'll position for the world their actions are creating rather than the world their words describe. Consider what major institutions do, not what they say. Central banks globally have been net buyers of gold for 14 consecutive years, accumulating over 1,100 tons annually. Why would central banks, the institutions that issue currency, accumulate the traditional alternative to currency unless they understand something about fiat monetary systems' long-term trajectory? Sovereign wealth funds have been systematically reducing bond portfolio duration and increasing allocation to real assets and inflation-protected securities. These are the most sophisticated, well-informed institutional investors in the world, with access to information and analysis that individuals simply cannot match. Their behavior tells you something important. That's why this channel exists. Not to predict markets or provide trading tips, but to observe what institutions do versus what they say. to recognize historical patterns before they become obvious, and to help you understand how central banks and financial systems actually behave during periods of stress. We observe signals before they become mainstream news, when there's still time to protect what you've spent decades building. If this analysis makes sense, subscribe to this channel. We'll continue monitoring the gap between central bank words and actions, because that gap is where truth reveals itself. The Martinez family observed that gap in 2007 and preserved their retirement. The Henderson family believed the reassurances and lost a decade. The same choice is in front of you now. The Fed will continue telling you they have everything under control. Watch what they do, not what they say. That's how you protect your financial security, your retirement dreams, and what you leave to your children.